Hi, in this video I will explain the regression analysis. A regression analysis is a powerful statistical method that allows you to examine the relationship between two or more variables of interest. It's a way of mathematically sorting out which of those variables does indeed have an impact on something. So let's see this in practice. We have a table and we want to analyze home prices. Our objective here is to explain the variation in home prices using the variation in the independent variables. So we want to see how our independent variables such as square footage, number of bedrooms, and number of bathrooms would impact the home prices. With this, we want to give an answer to a question why home prices vary and does these features impact the home prices. In order to do a regression analysis, first we need to add the analysis pack to Excel. Click on Customize Quick Access Toolbar and then click on More Commands. On the left, click on Add-ins, and then if you still don't have Analysis Tool Pack installed, click on it and click on Go. And you want to choose Analysis Tool Pack and click OK. Your data analysis set will show up under Data tab and under Analysis. Let's run the regression analysis. Click on Data Analysis and click on Regression. You will see a pop-up box for the regression specifications. Using this screen, you can then specify the dependent variable, our input Y range, and in our case, this would be our home listing prices. And the columns of the independent variables or input X range, and this would be our square footage, number of bedrooms, and number of bathrooms. If you included the variable names in the column headings, and these column headings are part of the range of observations that you specified, be sure to check the labels box. And we want to create our regression result in a new worksheet and click OK. We got our results. Let's interpret the summary output. The only thing that matters here is the R-squared, significance F, coefficients, and p-value. Multiple R is the correlation coefficient. It tells you how strong the linear relationship is. For example, a value of 1 means a perfect positive relationship, and a value of 0 means no relationship at all. R-squared is the coefficient of determination. It tells you how many points fall on the regression line. In our example, this is 86%. Which means that 86% of the variation of Y value, home prices, around the mean are explained by the X values, and 86% of values fit the model. To see if our results are reliable or statistically significant, we'll look at significance F. If this number is less than 0.05, then we are okay. If this number was higher than 0.05, we would delete a variable that has a high p-value, such as number of bedrooms, and we would rerun the regression until our significance F drops below 0.05. And we can see that there is positive relationship between square footage and home prices. So the larger the square footage, the higher the home price. And the coefficient of 89 indicates that on average, an additional square foot increases the home price by $89. And we also see that the other independent variable, such as number of bathrooms, is also positively related and explain the variation in home prices. For the number of bedrooms, we have a p-value that is higher than 0.05, and this is not statistically significant and indicates strong evidence for the null hypothesis. So this is regression analysis for you. Thank you for watching. See how we can use regression analysis to spot under and overvalued stock. We have P/E ratio of firms in the aerospace industry from the 90s, and we have data for expected growth rate and beta as well, and payout ratio. Beta is a measure of stock's volatility in relation to the overall market. A stock that swings more than the market over time has a beta above 1. A zero beta means that the stock is not correlated with the stock market. Now let's first calculate the average and the median for our table. The average P/E ratio of the industry is 13.2, and the median is 12.25. These ratios give us an estimate of the overall attractiveness of the industry's earnings. And we can now compare each PE ratio with the average. We use if statement to check if the PE ratio for each company is greater or lower than the industry average. Those companies that have PE ratio greater than the average are overvalued, and those who are below are undervalued. However, we need to be careful before jumping to conclusions. We know nothing else about these companies. What's the size, what's the growth potential, and investment opportunities. Parameters have to be the same to make a comparison. And this was just our estimate. Whenever you compare something, compare companies that are similar in size, that are similar in growth potential, and that have similar investment opportunities. Regression analysis can help us to discover undervalued and overvalued companies. We can control for difference across companies on risk, growth, and payout. With regression, we can calculate predicted PE ratio for each company. So click on Data tab, click on Data Analysis, and then click on Regression. Our input Y range is our PE ratio. And for our input X range is the expected growth rate, beta, and payout ratio. And we would like for our regression analysis to be in the same worksheet because we're going to use it for our formula setup. Excellent, we have our regression. Once you have your regression, you can set up your formula. Our predicted PE ratio would be equal to intercept from our regression analysis, and you can lock this, plus the first X variable, which would be our expected growth rate, times the expected growth rate for each stock, plus our second X variable, which is the beta, times the beta for each company, plus our third X variable, which is the payout ratio, times the payout ratio for each company. And you can copy the formula for all the companies. We have our predicted PE ratio. And you can see now that we use regression when we want to predict the future happening between a dependent variable and one or more independent variables. With this formula, we have a better PE ratio for each company. And if you calculate the change, and if you make the comparison with the predicted PE ratio, you can see the difference. Some companies that were overvalued are now undervalued, and some that were undervalued are now overvalued. Regression in our example is based only on few inputs, such as expected growth rate, beta, and payout ratio. And if we had more inputs, our regression would be even more accurate. Thank you for watching.